Hi, everybody. Welcome back to our channel. My name's Nithin Thomas. I have our guest, Jason, here, who is a lender here in Austin, Texas, who's licensed to serve the greater state of Texas as well. We're going to be today talking about alternate loan types, ITIN, and other various topics related to loans. And this is a part two of a three-part series with Jason. In the first part, we talked about loans, conventional loans, VA loans, and Jason will give a little more explanation into that. But first and foremost, let's introduce Jason, who is with us today. So, Jason, give us a good condition of who you are, what you do, why you do it, and then we'll just kickstart our show from there.
All right, Nithin, well, thank you for inviting me here today. I'm a loan officer. My name is Jason Bonifazi here in the Houston area. And I love my job because of what we can do and how I can help people get into a home. It's kind of the American dream is buying a home. So I get to be a part of that from the ground up as far as getting them through helping them through the process. So it's very rewarding and helping people. But I also enjoy another aspect of the job is to be able to go to real estate offices and assist in trainings, teachings, getting to meet real estate agents. So I find it very invigorating getting to talk to people and meet new people.
Fantastic. Well, I definitely appreciate you being here, doing the fact that you're providing information that a lot of people outside will need to know more about as they're kickstarting their journey of regardless of where that is. With that being said, I want to first talk about what we covered in the part one. So could you give us a 30-second understanding of the first part that we covered related to loans?
Sure. So we talked about what we would think of as the standard loan types to get into a house: the conventional loan, the FHA loan, the VA loan, and USDA loans. The vast majority of loans that we will ever do in mortgage lending will be those types.
Okay, fantastic. And if you guys want to watch that video, the link is below in the descriptions. Just go ahead and click on that, and you will have a chance to learn more about those loans that Jason just mentioned. You will also find our information. You can find me on any social media platforms. And Jason, where can society find you?
They can find me on Facebook if you type in Jason Bonifazi, or even if you do a search online of Jason Bonifazi, you'll come up with my primary residential mortgage website as well. Not a lot of Jason Bonifazi,
Yes.
so my name will pretty easily come up there.
Okay, fantastic. With that being said, let's get kickstart our show. So we have a lot of points to talk about here. ITIN is Individual Taxpayer Identification Number. And first and foremost, give us a breakdown of what does this mean. I actually personally have not seen this before, so can you educate me on this as well?
This is something also that a lot of people don't know about, even real estate agents who have been in the business for many years. So Individual Taxpayer Identification Number, ITIN, is somebody who does not have legal status here in the United States. They don't have a visa, but they live here, they work here, they have jobs.
Right.
The federal government knows they're here, and so they don't have a social security number.
Makes sense.
Well, what happens then? Well, the government still wants them to pay taxes. So they have a job, they're paying taxes, and the government assigns them this I-10. So whenever they're filing taxes, paying federal taxes, that they're identified.
Makes
So
sense.
with that number now, that takes the place of a social security number. They can still borrow, they can still take out loans on things. They can maybe buy a car, maybe whatever it may be. That's the 9-digit number that a social security number would usually cover. So they also have credit that can be established. So whenever I'm talking to someone about, and setting up their file for a loan,
Yeah.
if they're I-10, they can give me that I-10 number. I will run their credit report with that number.
Got it.
And they'll have a number, it'll
Right.
look like a standard credit report.
Right.
They'll still have the standard numbers, and any debt that's outstanding or their history of any kind of debt that they've had will show up on their credit report. So they are eligible to buy a house. They cannot get the housing, the mortgage types that we were just talking about.
Gotcha.
They're not eligible for those.
Okay.
So then they can buy a house, but they can't use any of those products. What can they do?
Interesting.
They can then get this I-10 loan, which is a brokered loan. So
Can you define a little bit more about what an ITIN loan and a brokered loan is, sort of the same thing? Yeah.
So a brokered loan is still a loan for a mortgage. The difference is that whereas I work for a direct lender, anybody buying a house, we will lend the money directly to the client. That's a direct lender.
Right.
That's what we do. Now, with these brokered loans, we don't loan the money. I become a middleman. So now a wholesaler will be the ones who actually make the loan for the person
makes
buying
sense.
the house.
Makes sense.
I become the
Okay.
middleman. So I still have to take in all their information, set up the file, but then the parameters change for what's needed for that loan to go through. They're considered to be riskier loans.
Makes sense.
Okay. So because they don't have legal residence here,
Right. There's a lot of factors that kick in. Yeah,
The wholesaler's now taking a bigger risk of giving a loan. So they're going to want more money down, and they're going to maybe want a higher credit score, again, a 620 credit score. They're still going to want the 2 years of history. But in addition, they'll want things like rental history.
Yeah.
Because you might not have as much documentation about your life and paying bills on time and whatnot. So they'll want some extra information. They might want 12 months of bank statements instead of the usual 2 months, things of that nature to get you into the house.
Okay, fantastic. Sweet. We're going to now shift and talk about alternate loan types. But before we go there, first and foremost, everyone, as you guys know, my name is Nithin Thomas, and you are?
Jason Bonifazi.
Okay, fantastic. The way you can find me is on social media. I have access to LinkedIn, YouTube, Facebook, Instagram, and I am also live on basically anywhere that you've searched my name. Could you just give us a quick introduction into where they can find you?
Yeah, Jason Bonifazi. So if you look on Facebook and type in my name, you will certainly be able to find me. Or even Googling my name of Jason Bonifazi, you'll easily be able to find me online as well.
So, Jason, we just spoke about ITIN loans. Let's now jump and discuss some things related to 1099 loans. So, the first question I have for you is, what is a 1099 loan? How does somebody qualify for it? And what are the traditional income types that typically go under the 1099 loan?
Yeah, this is one of those types of loans that it happens quite a bit because people are 1099 contractors. So they don't work for a specific employer, but they are paid as a contractor. So they get a 1099 every year stating how much they make. So whenever we're doing a typical 1099 loan, we will look at the 1099 of what they made, but we will also need to look at tax returns to find out what they truly made at their job, because people write things off, people
Right.
depreciate things in their business.
Right.
So whatever that number is on a 1099 doesn't necessarily reflect what's going
Right.
to be on their tax return. So in a typical loan, we would say, okay, well, you made, let's keep numbers simple, you have $100,000 on your 1099, but on your taxes you made $30,000. If you're taking a normal loan type, conventional loan, FHA, what have you, we look at that and say, well, you made $30,000 because that's what you paid taxes on. Now with a 1099, the parameters change of what you can be qualified for, the amount. Let's say you take that same person who made $100,000. We'll look at that and go, okay, you can get qualified on 90% of that. Well, that opens you up to a much
Right.
wider range of being able to afford a house over
Right.
$30,000. Now you can go up to $90,000 in qualifying income. Now, what's the catch? The catch is that you will end up putting a lot more money down on a house. The 1099 loan type is a riskier loan. So suddenly you'll be looking at something like 15 to 20% down on a house. You'll look at a higher interest rate than a normal loan type, a conventional or FHA
Right,
would
right.
be as well. So it's riskier on the lender's part, but we'll still do it. But that's the catch. So more
Makes
money
sense.
down, higher interest rate. But if you're a 1099 worker, a lot of times they'll say, hey, I'll take the higher interest rate, I'll take the more money down because I want to be able to get into a house of my
Yeah.
dreams. And if I go on the $30,000
Yeah.
that I pay taxes on, I can't really get anything near what I truly want.
Makes sense. And I want to know, does mortgage insurance apply for 1099 loans?
There is no mortgage insurance for a 1099 loan.
Okay.
It's another added benefit of
Okay,
that.
makes sense. Okay, fantastic. Let's now shift our focus and talk about bank statement loans. First and foremost, what is a bank statement loan?
So bank statement loans are, again, going to go into people a lot of times who are self-employed. They have a business, and we go back to that idea, we'll need to look at their taxes, right? We have to look at what they made. So again, you take the same person who paid taxes on $30,000. You're not going to be able to really get into a house of your dreams at $30,000. But that's what you pay taxes on because of write-offs and
Right.
depreciations and whatnot.
Right.
So another way of getting a brokered loan is to look at bank statements. So you have a business and you have a bank account set up with that business. What a bank statement loan does is look at all the money going into the bank account and then what's going out of the bank account. So it looks at those numbers instead, not looking at tax returns, looking at the money in and the money out. You have your accountant look over the numbers and say, okay, well, you had $200,000 came into the bank account and $50,000
Right.
went out for business expenses. Therefore, we can now qualify you on $150,000 income and go from there. Again, though, more money down on these types of loans because they are riskier. So
Right.
15 to 20% down is the usual amount.
Yeah.
And again, a higher interest rate. The reason people do this, especially who are self-employed, is because they can still continue to write things off and pay taxes on whatever their business expenses are,
Yeah.
and then still be able to qualify for the home that they would like.
Makes sense. Something that came up there from, as you were mentioning this, you said brokered loans. I do remember we talked about brokered loans. If you guys want to watch that, I'll link the video up here. But related to not related to brokered loans, specifically related to the bank statement loans, you mentioned it is a 1099 type loan. So does that mean people who are in 1099 can also qualify to get a bank statement loan? Is that correct?
They could also,
Okay.
if they want to go that route, that's
Okay.
also a possibility. You can either go the 1099 or the bank statement loan, whatever's more beneficial, what's easier,
Correct.
whatever it may be.
Yeah, whatever the bottom line is for the consumer at the end of the day. Got it. That makes sense. Okay. Let's now shift and talk a little bit more about what is the difference between a bank statement loan when it comes to a personal business account to personal bank account to a business bank account. Can you help me understand how you guys think about that when it comes to the bank statement loans?
Generally, with bank statement loans, they want to make sure that it's for the business. They would prefer for them to be separated with your personal account and business account. So some people, small-time businesses especially, sometimes there's a little mix-up. They will only look at what's going into your business side because your bank accounts will be gone over, let's say, 12 months to 24 months of bank statements. We're not
Yeah.
talking about 2 months. We're talking about it's going back a bit in time to look over all the numbers
Oh, wow,
that
okay.
came in. Yes. And yet another different factor playing into these types of brokered loans is that a lot more documentation for things like bank statements are going to be required. So they're looking at long-term bank statements of what's coming in and what's coming out of the account.
Okay, cool. Do you know, could you share if that's possible, what sort of time period it could be for consumers so they know what they should be saving in their records? For example, I would give a direct example. If I have Wells Fargo, which is a bank that I work with, they have like a 2-year cap where you can only pull like 2-year statements for some reason. I don't know why they do that.
Yeah.
But is there, let's say you guys have like a 3-year record, so then we need to go probably find that. So could you just, I'm just throwing that out there. I'm not sure if that's the case, but could you just give me an understanding of like how far you need information from?
24 months is going to be the
Oh, okay,
max.
so just 2 years.
There's
Okay.
It'll never go over 24 months.
Okay, fantastic. Okay, so just keep that in mind. Even though I said 3 years, it's not 3 years. I just made that statement there just for an example. So that covers the topic about bank statement loans. We're now going to shift and talk a little bit about DSCR loans. So let's go there. Okay, so we're now looking at the debt service coverage ratio loans. You have some points related to 1 to 4 unit investment properties, qualifying rents, and then corporate LLCs and things related to the credit score. My first question for you is, what exactly is a debt service coverage ratio loan?
Debt service coverage ratio.
It's a
loan.
mouthful,
It's
yeah.
such a yeah, it is a mouthful. Those are this is again one of those loan types that is not very well known. So it's more for investment properties.
Okay.
Other loan types we've been talking for have been personal. I'm going to live in this house.
Right.
But for investment properties, it qualifies you on a different basis. So what DSCR loans are looking at is the money that's coming in directly to that property. So let's take an example. I own 2 rental houses, but I want to buy a 3rd rental house. So instead of looking at my own taxes and everything that goes in my own, let's say I have another job, instead of dealing with any of that, you can get a DSCR loan and say, okay, well, right now I have these 2 houses that are investment properties. Let's look at the money coming in from those houses, and I can take money and I can pull money out of those houses to then buy the 3rd house. So it's only looking at the investment properties I currently have instead of looking at all my other documentation, just at the current housing I have
Makes
as far
sense.
as investment properties. So it makes the process much more simple, much more streamlined for people who are getting houses. Also for people who are LLCs, if they own houses, generally they'll get a DSCR loan because that way they can keep it in their LLC instead of having the liability on them personally. In addition, if you ever deal with somebody who's not an American national, let's say somebody from Mexico,
Yeah.
wants to buy an investment property. This came up a few days ago. They live in Mexico. They don't have a visa. They live in Mexico, but they want to buy an investment property here in Texas. What
Right.
can they do? They can buy a house. the DSCR loan would be what they can qualify for. So they don't have a credit score because they're Mexican nationals.
Right.
They don't have American dollars, but
Right.
they have Mexican pesos.
Right.
They would need to probably put somewhere down around 35% on a house, so fairly high.
Right.
Need to provide a government ID, passport could work, show that they have money in their bank account in their country, and we can then get a DSCR loan going for that individual. So a lot more money down, a lot more, let's call it skin in the game.
Yeah.
Again, interest rates will not be very
Yeah.
good for them because
Right.
it's a riskier loan type.
Correct.
But if you're ever dealing with a foreign national as well, that would be the loan type you go with somebody in that circumstance.
Interesting. You mentioned investors that typically qualify or more prefer for investors this type of loan. And in Austin, I've been working with investors who look at homes for rental purposes. And the way that I typically do the analysis for them is we look at depending on the rent that they can get in the market compared to the mortgage, how much their cash flow is.
Yeah.
So it says here qualifying using rents. So just for my investors' understanding, are you looking at it from the perspective of this is what the market's charging as a rent and this is what their mortgage is, and based on that difference, it could be positive or negative. In this case, it has to be positive because you're getting cash positive flow. Would that be the metric that you're using to define it as a cash flow, or is it another definition that you guys are saying when it comes to cash flow?
So let's look at it two different ways. Let's look at it as I already own a property and I want to buy another investment property. We can look at the documents of what you are currently getting in rental income and use that 100%. If you've had it for 2 years now, you paid taxes on it, whatnot,
Right.
you have 2 years of history with it, we can count 100% of the income. Now, if you are buying an investment property as a single guy, maybe not even doing with a DSCR loan, you're just trying to find it and buy an investment property, you can still qualify using that investment income, even though you don't currently own the property, you
Right.
will be renting it out.
Right.
Whether it's a 1 to 4 unit property, we would look at and say, okay, you're going to rent this out. We can count 75% of the potential income for this property.
I see.
Because you don't own the property. You
Right.
have never seen a
Correct.
dime
Yeah,
out
correct,
of it.
correct.
So we'll say, okay, so whenever you have the appraisal done on the property, the appraiser is going to look at the value of the property, of
Yeah.
course, but also say, okay, well, here are the rental incomes in the immediate vicinity, the area around this property, so we have a pretty good idea of
Okay.
what you'll be able to
Makes sense.
charge
Okay.
as rental income and count 75% of that.
Okay, that gives clarity, especially on how you measure the cash flow. I want to now ask another question, which is, how does this loan benefit investors? The reason I'm asking that question is, I know in some situations, people who want to get a primary home, they sometimes will say, hey, I'm going to live in it for 2-3 years, but I know for a fact that that's going to be my home. But after that, I want to probably rent out one room. But by that time, hopefully my loan has some variabilities in the statement or whatever it may be, which is a little bit more technical, and we need to talk to your lender and figure out what sort of loans can you use to get an investment property. There are some criteria that goes into it. But the question that I have for you, Jason, is how does an investor kind of benefit from going and using a DSCR loan versus another loan type that might exist for them out there?
Yeah, it's just a much simpler process to get a DSCR loan because we don't delve as deep into your taxes and whatnot. It would just be looking at the property at hand.
Okay.
So again, if you already have the property, we're only looking at the income and expenses of that property.
I see.
And based on that, think of it as a cash out refinance. You want to pull out money from this house to buy another investment property, that would be the way to go because it's so much simpler because we're only looking at that house or multiple houses, whatever you may be doing, looking at the income, the cash flow in and out of that property to get you money to buy another house.
Makes sense.
It's a much easier process.
Makes sense. Is there a loan limit that you should be thinking about from an investor's point of view when it comes to DSCR loans?
No, there is no loan limit on this type of loan.
What about mortgage insurance?
No mortgage insurance either.
Okay, fantastic. Awesome. Well, this covers the segments related to ITN and alternate loan types. We're now going to shift in our part 3, talking about down payment. Before we wrap up this video, Jason, could you give us a quick closeout of how people can get in touch with you and any other statements you want to share to the world?
Absolutely. Again, my name is Jason Bonifazi. I'm a loan officer with Primary Residential Mortgage. And if you want to look me up on Facebook, just type in Jason Bonifazi or just a quick search on the web, you would come up with my website with Jason Bonifazi with Primary Residential Mortgage.
Okay, fantastic. Well, Jason, again, thank you so much for this part two in our series. We're going to be going to the next segment. But for everyone out there, make sure to check the description below. You will find both my information and Jason's information there. As Jason mentioned earlier, you can search him up on web. Also find him on Facebook. You can find me on all social media platforms: Facebook, LinkedIn, Instagram, and YouTube. Make sure to subscribe to this YouTube channel. And if you have any other statements you want to share, just drop in the comments, and I'll be more than happy to interact with you there. With that being said, I will see you in the next clip.